Generating $2.21 billion in free cash flow usually guarantees a flawless earnings report, yet Newmont Corporation is battling a hidden paradox of severe cost inflation. Does this cash cushion mask structural deterioration that analysts are ignoring, or is this the ultimate value play? Q2 revenue of $6.12 billion initially looks like a solid victory. Headlines scream about the 15% year-over-year growth, but closer inspection reveals a painful 16% sequential decline. The business suffered a sudden drop in average realized gold price, falling $486 per ounce down to $4,414. This reveals how hypersensitive the firm is to external market dynamics. If the US dollar index, currently at 100, strengthens further, this pricing pressure becomes a sustained headwind. To grasp why this matters, look at the underlying profit engine. The firm reported a 58% sequential surge in all-in sustaining costs, hitting $1,621 per ounce. Most observers focus on the broader commodity cycle, assuming fixed expenses naturally balance out. The reality is that physical mining infrastructure demands constant capital, and when volumes drop, fixed costs penalize the bottom line. This inflated cost structure threatens to compress free cash flow margins if metal prices cool down, turning an anomaly into a structural headache. That production drop comes directly from tangible, heavy physical operations. The business experienced a sudden 43% sequential drop in total copper production. The broader market is captivated by forward guidance, ignoring that this output collapse was a direct result of unpredictable seismic downtime at the Cadia mine. For investors, this is a stark reminder that underground assets are uniquely vulnerable to random geological events. No financial model accounts for the earth shifting, and further geotechnical delays could disrupt the annual production targets set by Newmont Corporation. This brings us to the elephant in the room regarding profitability. The company posted net income of $2.2 billion, equating to earnings per share of $2.06. Casual analysts treat this 6.8% year-over-year increase as proof of operational resilience. However, this overlooks the $1.06 billion sequential drop in net income from the first quarter. This quarter-over-quarter swing encapsulates the earnings paradox. Strong absolute numbers mask underlying volatility driven by pricing fluctuations and sudden production hiccups, forcing us to reevaluate the stability of the business. We see this friction directly in core efficiency metrics. Gross margin contracted down to 56%, which pulled operating margin down to a sequentially lower 53.4%. While objectively strong, this compression signals Newmont Corporation might be hitting a ceiling in pricing power against creeping operational inefficiencies. This is why your portfolio might feel stagnant right now, despite optimistic sector reports. Management appointed new executive leaders to address this, but without rapid intervention, this margin squeeze could limit upside potential. Yet, despite these margin pressures, we must acknowledge the financial armor protecting the company. Free cash flow margin remains exceptional at 36%, proving cash conversion is incredibly robust. The firm boasts a balance sheet with cash and equivalents standing at $9.01 billion. Against that, total long-term debt sits at $5.08 billion, yielding a conservative debt-to-equity ratio of 0.14. With the federal funds rate between 3.5 and 3.75%, a net cash position of $3.41 billion ensures the business is insulated from broader market volatility. This balance sheet power grants management optionality to deploy capital aggressively, while competitors struggle with debt service. The company engineered a brilliant capital allocation maneuver by executing a massive float reduction. The stock buyback program deployed $1.57 billion in the second quarter alone. Since early 2024, the firm retired roughly 9% of its outstanding shares. Casual observers assume buybacks are standard corporate routine. The true strategic edge is that shrinking the float automatically increases earnings per share and dividend yields for remaining investors without raising cash liabilities. Management is concentrating per share equity value. signaling they believe the stock is intrinsically undervalued. This disciplined approach extends directly to how the business sustainably rewards long-term shareholders. The declared quarterly dividend translates to a conservative dividend payout ratio of 12.6% against the quarter's net income. Instead of chasing unsustainable high yields to attract retail investors, Newmont Corporation opted for absolute dividend safety. This ensures the payout remains sustainable even if commodity prices endure a downward correction. Once you grasp this, you will look at capital return programs in a completely new light. It caters perfectly to institutional investors seeking reliable returns amidst unpredictable global economic uncertainty. Before declaring the firm a flawless compounding machine, we must account for capital anchors. Environmental remediation remains a massive drag on long-term cash flows, with the company spending $458 million on reclamation liabilities in the first half of the year. Heavy physical infrastructure projects like the Yanacocha water treatment plant carry an estimated total price tag of $1.8 billion. The general consensus ignores these liabilities until they appear on the cash flow statement. Investors must underwrite these environmental commitments as a permanent structural tax on the valuation of the business. Finally, we must evaluate the forward expectations game. Management is backloading their operational reality check, issuing forward guidance that projects 51% of annual production and 58% of sustaining capital spend will occur in the second half of the year. The investment crowd assumes this means the firm is simply pacing its growth. The fundamental truth is that this projection places immense execution pressure on the next 2 quarters, relying on deferred development projects coming online flawlessly. If execution falters, the outlook shifts quickly from an on-track triumph to a catastrophic guidance miss, leaving no margin for error. This brings us back to our opening paradox regarding Newmont Corporation. How can a business generate $2.21 billion in cash while battling severe cost inflation and physical mining disruptions? The truth is, the company operates as a financial fortress housed within a highly vulnerable physical reality. Geotechnical risks and reclamation costs place a structural ceiling on peak profitability, but massive liquidity and float reduction act as a powerful counterbalance. For the pragmatic investor, the current valuation offers a margin of safety, provided you understand commodity cycles. This is not a risk-free compounding machine, but thanks to zero net leverage and a disciplined capital allocation strategy, it remains a premier vehicle for strategically shielding wealth against global market uncertainty. But I want to hear your take. Does this massive cash position completely offset the hidden risks of physical mining, or is this cost inflation a warning sign you cannot ignore? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.